Hello and welcome to Investing Confidential. Well, messy day today in the markets. It's a mega cap day sell-off, rightly so. I'm going to discuss why these stocks are selling off, why there's pretty much no bottom in the short term, and everything was triggered by good news, believe it or not. Well, good news is relative. But anyway, let's talk about the big news today, which everyone is yapping about and people don't understand, which is GDP. Okay, so here we go, the GDP release, as you can see here. We had gross domestic product for the third quarter up 4.9%. Everyone's jumping up and down. Look, again, I've been talking to you guys for a long time. The headline is a joke. Don't believe the headline. You have to go deep in. And so we're going to go deep in right now. So again, the headline number looks amazing. But again, we talked about good news is bad news. The Fed doesn't like a 4.9% GDP number. And obviously, this is not good for the direction of rates and Fed's decisions. But let's dig deep into the number. So here we have the stats on the GDP. Okay, so again, on the upper right-hand corner, you see that 4.9 print, the domestic product, that's the gross number. But let's look deep in here. Okay, I'm going to focus on this individually. So let's look at durable goods. Okay, durable goods, wow, look at that, 7.6%. Whoa, that's a big number. I'll show you why that's impossible. Again, you got gross domestic investment. This is mainly inventories, primarily inventories. People had dumped a lot of inventory. Now they're building it back from a very low level. So it looks like a big number. It's not. Okay. And again, this is inventory is not, it's not real. It's not creating jobs, just inventory. And then finally here, we look at imports and exports. Again, these numbers look impressive, very impressive. And then you go down here and look at this. And on a weighted basis, this is the big one, federal government consumption, spending, investment. The government is priming the pump, folks, priming the pump. They do not want this stock market. They don't want anything to go down. And as I told you before, none of these statistics are I'm not going to say they're fake, but they just don't make any sense. Okay, and as I showed you numerous times, the way they gather this information is just faulty. Okay, and it really is misleading. Okay, and so let me show you some things here. So they talked about import exports. Look at this. This is real data, folks. Truck tonnage. It's falling off a cliff. That's import exports. That's consumer goods. It's impossible for a GDP of a country. Remember, trucking is the core. If our trucks went on strike, we'd be having food riots. I mean, everything is about trucks, and truck tonnage is tanking. So how on earth do you have almost a 5% economic number? It's impossible, folks. Okay, here's what confirms it. UPS. This is today, this morning, they cut their annual forecast. Look at this. Read it and weep. Weak delivery demand. This is consumer. This is goods moving. This is imports. This is exports, folks. What I'm telling you is the real numbers tell you one thing, and the government numbers are telling you something different. Okay. And now let's look at the big number here was durable goods. Okay, massive number. This is Wikipedia. What's durable goods? Okay, this is Economics 101. These are hard goods, consumer durables, right? Cars, houses, big utilities, your refrigerators, et cetera, et cetera, et cetera. And this is not staples like food people need and energy. This is durable goods that household goods, people buy and whatever, and they hold on to for a long period of time. This is not something that, like, for example, you buy groceries and they're gone in a week. No, this is stuff that's durable, right? That's the definition. Okay, so the durable goods was a big number. And I just showed you how weak the actual deliveries and the economy is. So how on earth do you have a durable good number that's off the charts when I showed you in past videos I mean, there's been weakness in consumer electronics. There's no houses being sold, folks. No, the volume is, there's no supply. They're laying off realtors left and right. The reality is one thing, and the government is telling you something completely different. Okay, and here, let's go again to the government data. Here's a note. Real disposable personal income decreased by 1%. I don't understand how no one's reading this stuff, okay? You got a very strong GDP, durable goods, all these things, imports, exports. Disposable income is decreasing. None of this makes any sense. Doesn't make any sense to me. And I'm a professional investor. Okay, this didn't happen in the past, where real data completely contrast what the government says. This happens in China, but doesn't happen in the US. Okay, and then let's look at what's going on in housing. Then we had a housing print today. Okay, pending home sales. Whoa, pending home sales grew 1%. Wow. But the reality is, so what you see here at the bottom is all the regions in the US year on year, okay, not month to month, which is what pending home sales tells you, 1%, oh wow, August to September, no. Year on year, everything has declined. Transactions have declined. Prices are still declining. And yet, you had a big durable goods number. I can't tell you how just ridiculous this is. Okay, and again, going back to this whole regional thing, here's what's really going on. Okay, year on year, all over the country. Okay, look at this. This is very interesting. So you got Austin, Texas, which was the hottest market in the United States. It's the canary in the coal mine. Okay, it led the way up. Now it's leading the way down. Okay, and you got Phoenix is in there, other parts of Texas, whatever. And then what's up? Okay, Hartford, Connecticut, New Haven, Connecticut, Rochester, New York. Look, not for nothing, folks. Syracuse, Knoxville, Milwaukee, Bridgeport. I'm not knocking these cities, but these are some of the most depressed places in the United States, real estate wise. People have been moving out of Connecticut like nobody's business, especially places like Hartford, New Haven, and Bridgeport, just decimated. And prices have got so low that it's the only place people can afford. So obviously, those prices are going to go up. But they're coming up from these things were depressed 20 years ago. Now they're even worse. So sure, people are going to go and buy the homes that are depressed because everything else is too expensive. Rochester, Syracuse, these are, and all of these cities, by the way, they're all, cities of the past. Okay, they were booming in the past. They've been depressed for 20, 30, 40 years. The prices are so low that people have no choice. They can't afford anything else because everything else they're priced out of. So you got to look at the data. The data tells you everything. The headlines, waste of time. So now let's look at Meta and the big cap techs in general, the market in general. And again, the data is what I'm going to show you that makes sense. Okay, so here you see Meta, the net income. This is why initially, people jumped on it. Some of the day traders started buying it initially after the numbers. I mean, look, let's face it. This was a spectacular quarter, net income wise, absolutely spectacular. And look at the cash they generated. I mean, free cash for the quarter. Massive move in free cash. Massive movement in free cash. 20 billion. I mean, it's a staggering number. Here's expenses. Okay, they've fallen off a cliff. Why? Well, Meta fired 25% of their workforce. I mean, 25% of your workforce. That's huge. Okay, obviously, that dramatically reduced expenses. And so, ergo, They had they generated incredible amounts of cash. They had a great quarter from a net income standpoint. But it was really pure to firing people. Okay. And then, so why is the stock down? Well, so, Mark Zuckerberg and the manager, they're like drug addicts. They have all this cash. They're going to spend it now. Okay. They're going to increase spending dramatically on AI and the metaverse. And their ad spending was not what should have been, probably more flat to down from expectations. And again, guidance, higher spending, because they have a lot of money, so they're going to spend now like crazy, and their ad spending is going to be weaker. So look, it's all about the future. So this is why Meta stock's getting crushed today, hit hard. This is a big move down for Meta platform. Okay, and it's purely to do with the guidance, because the current quarter was spectacular. Okay, and the same thing happened to Google. Okay, their ad spending is weak. You got government scrutiny, and it all comes down to this. Look, these mega caps, folks, these mega caps were very, very expensive. Okay, and talking about mega caps versus everyone else. I mean, here we have the S&P 500, equal weighted, meaning the average S&P 500. The valuations of the average S&P 500 is now below pre-COVID levels. Pre-COVID, I told you everything is about pre-COVID. Folks, I still say, people think I'm nuts, stock prices won't be able to go back to the highs until they test pre-COVID levels, or the COVID level, COVID lows, whatever the hell they call them. So these mega caps have got to come down, and they're going to take everything down with them. Okay, look, today we say, this is as of yesterday's close, we're at the 200-day moving average. So with today's movement, and it's Thursday, October 26th, we're now below. We're going to close below the 200-day moving average, which is never good on a technical basis. The last time this happened significantly, as you saw, was 2002, and we didn't really bottom out till October. So we went from the beginning of 2022, we had that massive move in 2022. So just be aware that we're breaking technical levels for fundamental reasons. And forget about geopolitical. And then here, this is big picture stuff, folks. This is investment themes of decades. Okay, we go back and we look back to the 50s, European. We had, again, the big one is Nifty 50s, followed by the inflation era, okay, the 70s. I think we're in a similar pattern. So if you look now, it's about the mega caps. And the mega caps are done. So the last time we had this move of mega caps, meaning this Magnificent Seven today or the Nifty 50 in the past, we were entering an inflationary period. And look, in the 70s. So we're going to see something similar. I mean, because inflation is not going away. It's not going away. And if you think history can repeat itself, which I think it does, every once in a while it does, you've got to be very careful, because the mega caps have been incredible performers, but I think they are done. They're absolute done. Apple, I mean, come on. It's obvious. Apple has seen, 3 trillion market cap. That's insanity. It's all driven by algos, not fundamentals. So where do you go? Commodities. Everyone laughs, but here, I talked about commodities. I'm not going to go into it again, but give you a specific theme. Look at Latin America. This is the breadbasket of the world, folks. Laugh as you will. Peru, Chile, and Brazil, and Argentina. They have the most fresh water in the world, non-polluted fresh water, by the way. That's important. And they basically, if the United States really wanted to isolate themselves from all this nonsense going on in Europe and Asia, just wall off the country and just make deals in Latin America. They got all the food, They got all the water, we got all the innovation. We need anybody else. Let them blow each other up. But that's never going to happen. But this is where you need to start looking. You need to start positioning yourself because the dollar is done. The dollar is the next shoe to fall, as I've been talking about. Okay, and look, here's some other things that you be aware about. So buybacks have been a big theme. Buybacks basically have driven the market higher over the last since the end of 2000, not since the beginning of the 2009 bull market. Okay, I don't believe the bull market ended with COVID. I think COVID was just a 1 month event. So forget about COVID. So the market bottomed in March of 2009. It's been going up ever since. It's done now. But buybacks were a big, look at buybacks now. The buyback stocks are underperforming. So companies are buying back stock and the stocks keep going lower. That's bad. That's very bad. Okay, and then here's Europe. This is stuff to really worry about. Europe isn't, look at these PMIs. They have fallen off the cliff. Europe is officially in confirmed stagflation. They're done. Germany, it's a disaster. Absolute disaster. And one final chart that, again, I've talked about this before, this term called financial repression. It's something you're going to hear about. You're going to look back, whoever watched these videos, the three of you who are watching these videos are going to say, whoa, that dude was right. Yeah, I'm right. Financial repression has begun, folks. Nobody else is buying these stupid treasury bonds but you. That's right, you. Indirectly or directly, you're the one buying these bonds. And this is what the government can't sell them overseas. They can't sell them to anybody who's the smart money people. So guess who's buying them? You. And that is the definition of financial repression. And that is what happened in Japan. And they went 30 years in a bear market. 30 years. Okay, that's where we're headed, folks. QE, all this nonsense, the Fed, they drove us into the ground. This GDP is the top. This is a joke because I told you how it really is a fake number. But this, what you're looking at on the screen, this is you. You're supporting this printing, this money printing. Nobody else wants it but you, indirectly and directly. So, as always, investors, be careful out there.